here's what happens. We add up the total of all of your active income. Let's say, for this particular person, it happens to come out to $72,000 per year. Great. That's a fairly reasonable annual income. This person probably does okay. We say now, when we're putting disability insurance in place, because disability benefits are paid with after-tax dollars, we want to take this into account. We don't want this person earning more income while disabled than they did while they were healthy. If they end up earning more income while disabled than they did while they were healthy, we would say that takes away the motivation to go back to work. We want to make sure there's a motivation in place to go back to work. So, here's what happens. We want to bring this income to approximately the same level that it was after we took away this person's income taxes, keeping in mind that disability income is going to be tax-free. So, normally disability benefits are calculated on a monthly basis. So we can see that this person has $6,000 per month of income. Now the insurer is going to say, we're not going to provide 100% replacement here. We're going to replace just a portion of that income that person had previously been earning. This depends on the insurance company that you're dealing with and depends on the contract that you enter into. But it could be any of these amounts, and there are some other possible variations here. But these are fairly common amounts. Somewhere between 50 and 70% of your disability, of your healthy income is what we're going to replace here. So let's say for this particular person that we said we're going to provide a 60% benefit. 60, 65, and 66 2/3 are all fairly common in the insurance industry. So what we would see now is that this person, if they become disabled, and they had purchased this particular disability policy, assuming $72,000 of annual income, $6,000 of monthly income, a 60% benefit, this person becomes disabled, and they will start to receive, assuming that they meet the definitions of disability and their disability insurance policy, this person will start to receive $3,600 per month of disability benefits. So this will be the disabled person's disability benefit, and of course it's paid tax-free because this person paid their individual disability premiums with their after-tax dollars, meaning that the product's already been taxed. Revenue Canada is more than happy then to watch you collect these benefits tax-free. Now that we can see how to calculate the need for disability insurance, our next step is going to be to calculate the morbidity. So taking into account how much disability insurance this person needs, we're now going to go on to the next stage. Now, those of you that are familiar with life insurance will already be aware that with life insurance, we want to look at age, gender, and smoking status. Those are very important considerations for disability insurance as well. For life insurance, those would be the most important considerations. But for disability insurance, while age, gender, and smoking status are important, the most important thing is actually going to be, what does this person do for a living? Their occupation. So we're going to break down, for our purposes here, 5 occupation classifications. There are some insurers out there who would use 6 occupation classifications, but for the most part, if we work with 5, we'll be in good shape. We'll understand how these concepts work, and will help us going forward. Not all insurance companies use this numbering system. It's not uncommon today to see a different numbering system, 4A, 3A, 2A, A, and B. And what we'll find here is that different occupations will fit at different points along this chart. Our 5s are going to have access to the most generous definitions of disability. They're going to pay the least on a dollar-for-dollar basis for their coverage, whereas our 1s are going to have access to the most restrictive definitions of disability, and they're going to pay the most for the coverage that they receive. So let's have a look at our 5s. We'll see who fits into these categories. I like to think of this as kind of an alphabet soup. So we have up here people like the CEO of a company, or some insurers would insure a dentist up here, or a medical doctor, or a chartered accountant. These would all be good examples of people that would fit into this occupation class 5 or 4A, although some insurers treat dentists differently. Our 4s, in our 4s, we're going to have other sorts of professionals. We would have here, for example, our skilled office workers, your human resources professionals, for example, the people who work in the accounting department, maybe. These people who have typically some sort of a professional designation or a degree in order to do whatever it is that they do. Our 3s, we're going to find here, salespeople, for example, a lot of insurers will insure teachers here, and you'll find some insurers, depending on the exact nature of the duties for this person, but insurers will insure non-office supervisors in some cases here, such as a foreman or a site supervisor. Our 2s then, in our 2s, we're going to find skilled laborers, and most tradespeople, although not all tradespeople are necessarily going to fit here. And then our 1s, we're going to find down here, typically our riskiest occupations. This is where we would find unskilled labor type of jobs, and agricultural workers.